What's up, guys? Kareem here. So, as you know, the housing market has been on fire over the last year. According to one report, houses have been selling in just 3 days in this red hot market. CNBC said that the housing market is insane, while the CEO of Redfin said it is hard to understand how bizarre this US housing market has become. We've seen prices surge at the fastest rate since 2005, but this seller's market on steroids may be about to change soon. A CNBC report says the housing boom is changing as supply is up and rates head lower, while CNN says that the housing demand is about to weaken, while another report warns that the housing market could soon hit bottom. So let's break down what's going on in this unprecedented, bizarre housing market and see if we can determine if the market is about to take a plunge, as some are predicting. In order to understand where the markets are headed, it's important to look at how we got here in the first place and the events that led up to this red-hot housing market that we're seeing today. While record low interest rates certainly acted as a catalyst to spur up this home buying frenzy, there were also other factors that influenced the market. First, we have the housing shortage. According to NAR research, the housing shortage wasn't completely a new phenomenon that was triggered by the pandemic. Low inventory and high demand leads to higher prices. Inventory is the number of houses on the market that one can buy today. They say we were already facing a housing shortage going into the pandemic, and the pandemic just made it worse. As one NAR report points out, supply is short because we've been underbuilding for decades. And the second is builders were unprepared. The unexpected turn of events due to the pandemic left builders with more demand from home buyers than they could keep up with. The demand is something that they would have had to have prepared back in 2019, which they didn't because, as we know, the pandemic hit unexpectedly without any warning. As the pandemic hit and lockdowns were put into place, people were forced to spend more time at home, which ultimately led to the third factor, migration to suburbs. They say the stay-at-home orders and work-from-home options increased the premium on the comfort of the homes and created the need to prioritize space. This led many Americans to flee densely populated cities for the suburbs and in the process traded their apartments for homes while the rates were still low. Others saw the remote work option as an opportunity to move to low tax rate states as they could now essentially work from anywhere in the country. But this migration created a new demand for housing, something the construction business had not anticipated. This brings us to the fourth factor, that of construction materials. Supply chain issues led to lumber hikes. The higher cost of building discouraged builders, and some contractors were holding off construction until it was economically feasible to build again. The lumber shortage issue was further compounded by the fact that there was not enough building space to construct new homes. Unable to find a new home, buyers were forced to look at inventory in the pre-existing home supply, but this had its own set of problems, as we will see in the next 2 points. The demand for rentals has increased because some Americans are unable to purchase homes at affordable prices. Investors saw this as an opportunity. This has led to a buying spree of homes by investors who plan to repurpose them as short and long-term rental units. Business Insider says major asset firms have purchased hundreds of thousands of homes with the intent to repurpose them as rentals, which has further increased competition for home buyers in an already hot property market. Another report says investors are buying up thousands of homes to rent on Airbnb. This has in turn squeezed out everyday Americans out of an already crowded housing market. This has become a tough market, and those who can are holding on to their homes. One such generation is the baby boomers. Sixth, we have the effect of baby boomers on the real estate market. Baby boomers hold more real estate wealth than any other generation. Typically, older generations sell their homes and move in with family or in senior facilities, but this isn't the case right now. Because of the pandemic safety concerns, many boomers are not listing their homes and moving out. The desire to stay put is worsening the housing crisis. There's another generation that cannot be ignored in all of this, and that is the millennials. Seventh, we have the demand from the millennials. According to Zillow, millennials have additional savings as a result of the pandemic, which they plan to use as a down payment for a house. Homeownership is still a priority among the rent forever generation, and they intend to use their newfound savings as a way to make this dream possible. Money that would otherwise have been spent on travel and leisure was getting saved and invested. Millennials are turning 25 to 40 in 2021, and for many, these are prime years for home buying. This demand, combined with other factors, has created bidding wars nearly everywhere in the nation. So having said all that, the big question is, are housing prices going to continue to skyrocket, or are they on their way down after reaching a record peak? And are we in a housing bubble that's about to burst? Fortunately for those in the real estate market looking to buy, the tide seems to be turning. So if you look at what's going on with the current prices, There is some light at the end of the tunnel for home buyers. Housing starts rose more than expected in June, although a lot of the starts were on homes that have already been sold. The latest figures released in July of this year show housing starts increased by 6.3% in May, although the same report warns that building permits, which is an indicator of future starts, was down 5.1% in May. Another indicator economists have used to predict the slowdown in the second half of the year is the rate of mortgage applications. They say we are now starting to see the effects of the 26% drop in mortgage applications that were filed between December and April. If this trend continues, they argue that sales could soon hit bottom. Stress lines are beginning to show in the housing market as a result of being overvalued. They say these overvalued markets are vulnerable to price corrections as mortgage rates eventually rise. This will cause the housing markets to weaken and housing prices to decline. Some experts are predicting that there will be a glut of homes that will flood the market as the foreclosure forbearance period ends on July 31st. The question is just how many homes will be added to the inventory. Are we going to see a glut of homes like we did in 2008? According to the National Association of Realtors, the worst case scenario is that there will be 400,000 homes that will go into foreclosure. While this will add some additional inventory to the market, it is important to keep in mind that in the 2008 crisis, there were 3.8 million homes that went into foreclosure compared to the 400,000 that are projected in 2021. Furthermore, the foreclosure process is long and drawn out, so it's highly unlikely that all these homes will be added to the inventory all at the same time. So that was a lot of numbers, data, and analysis, and I know it's a little daunting to make sense of all this and try and make an educated prediction on where the housing prices are heading. So here's my take on it. This coming from somebody who's been involved in the real estate industry for the last 10 years, both at the professional and personal level. For the near future, I don't expect the typical real estate cyclical boom and bust that we've all come to expect. Instead, I see a correction happening, which is a relatively minor drop in prices. The crash that some are predicting just simply isn't in the cards right now. A crash is defined as something greater than a 10% drop in the home price index from a 52-week peak value, something that is unlikely to happen anytime soon. This is because a huge foreclosure spike is unlikely as the owners exit the forbearance period. Most homeowners have a payment plan in place which will allow them to continue ownership of their homes. What this means is that the majority of the homeowners have either resumed their payments or have made loan modifications that will allow them to maintain possession of the homes. Of the remaining small percentage of homeowners that will be facing foreclosure, this will result in a small increase in inventory, but that is something that is unlikely to cause a market crash. Besides, it only makes sense that if prices are rising and owners have equity in their homes, they're going to do everything possible to keep their homes. And any little inventory that comes in the market as a result of foreclosures will quickly be gobbled up by the years-long pent-up demand. Having said that, I think the US market is too big to be considered as one, so there will be pockets of micro markets that will experience a higher rate of foreclosure that may result in buyer's market conditions in certain hyper-local markets. Another reason why the market slowdown is going to be different from 2008 is that the catastrophic events of the last meltdown are still fresh in the government's minds. They say this time around they are more aware and better prepared to put measures into place to avoid a repeat of the last foreclosure crisis. The industry as a whole, including the regulators, are going to try and keep owners in their homes. The interest rate policy is going to be largely unchanged to ensure stable lending conditions are maintained. Plus, if I were to guess, the existing shortage of upwards of 5 million homes is going to take some time and drastic measures for us to see any significant reversal of the shortage, especially given that there are tens of thousands of homes that are being bought by large institutions for the purpose of renting. To me, this means there will be fewer homes available for the everyday Americans to buy. So to sum everything up, I don't see any significant crashes happening. Instead, I see minor corrections happening that will gradually start to balance out the market. So that's all, guys. Hope you liked the video. See you on the next one.